This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. So it was just a Cameron and Ben solo episode today.
Yeah, Happy New Year.
Yeah, Happy New Year, yeah.
We've had so many guests lately. So just a quick intro. We covered a lot of topics that we had kind of backed up for a few weeks. Talked about update on the ETF marketplace in Canada.
Yeah, I mean, we went through a bunch of stuff. We chatted a bit about some of the guests that we had recently that we're going to be releasing over the next few weeks. But there's lots of stuff that we, like Cameron said, backed up over the holidays, so it was good to...
Crazy idea of going to cash.
Yeah, should you go to cash? We answered that question. Anyway, good opportunity for us to talk because we've been mostly listening to guests for the last few episodes.
And they've been good. We've had some really great people and more coming up.
Yeah, hopefully people still find us interesting.
We'll see.
All right, there you go. Welcome to episode 29 of the Rational Reminder Podcast. It's just Cameron and I today. We've had a bunch of guests, including two that we recorded today that won't be released for a while. But this is our third recording for the day.
Yeah, so we had great interviews earlier today with Larry Swedrow from Buckingham in the US, and then the head of iShares in Canada, which was a great interview.
Yeah.
This is after 3 weeks of superb guests, so we thought we'd better have some of our own homegrown content today.
Yeah. So anyway, we wanted to start off just throwing it out there that we are hiring for a position here in our team in Ottawa. Yeah. Anyway, just throwing that out there.
Yeah, we're always looking for good people. So, I mean, the jobs are posted on the website. So if you're interested, drop us a note.
We have had a couple people that I know listen to the podcast that I only know through the podcast that have actually reached out and applied for positions that we posted in the past, which is kind of neat. We just on the podcast, our plan is still to start filming them. We just haven't actually filmed any yet, but that's coming, hopefully. If anyone cares, like, do people care to watch us do this?
It's beyond me, but
apparently it's a thing. Anyway.
So you want to kick it off by talking about ETF and index investing, some updates that you came across?
Yeah, well, I mean, the big one is that RBC and iShares have formed an alliance. And we learned today in talking with the head of product for iShares Canada that it's an alliance. And when I noticed reading the article later on that was very specifically stated.
But what a huge alliance. I mean, two monster companies.
Yeah. Well, it came out in our conversation. It comes down to scale, right? They're sharing resources.
Right.
And that's the game. The name of the ETF game is gather assets, which is a fee competition because it's a commodity at this point. So you are required to scale. And what's better for scale than combining something like RBC with something like iShares?
So I guess they're going to be combining the sales force, but they're not rationalizing products, of course. They're each keeping their own product line. They're rationalizing on the sales side.
Well, it sounds like the whole back end, it sounds like they're going to be combining, which makes sense. Like, of course you need to do stuff like that if you're going to continue to be competitive. Yeah. So it seems like an obvious move. And I guess the other big thing is that RBC has this massive distribution channel,
yep,
and iShares, they don't have that. So that's an obvious synergy as well.
And also with Vanguard ramping up, I would think, bigger competition is only a border away. I mean, I know Vanguard's here now and they've had some impressive asset growth, but compared to the US, they're not really that big a player in Canada yet.
No, and you know what I learned recently is that how Vanguard, one of the big benefits people talk about is that they're mutually owned. That's only true in the US. Their international subsidiaries are not mutually owned.
I didn't know that.
Yeah. They're for-profit companies set up by the US entity in other countries.
Have to dig into that a bit.
Yeah. Yeah, I didn't verify that, but I heard it. Thought it was pretty interesting.
Pretty amazing how VGrow picked up $500 million in new assets last year.
You believe that?
That's a lot.
That's a ton of assets. 25 basis points too.
Yep.
That's the fee. Pretty good business, I'd say, for a year. Less than a year. Because they launched in February last year, I think?
Yeah, so VGrow is the one-ticket solution offered by Vanguard where you get a diversified portfolio.
Yeah, 80-20, 80 stocks, 20 bonds. They launched 3. I don't know what the other ones grew, but anyway. A couple other things on Canadian ETF space. BMO was the biggest last year in terms of growth. They brought in $5 billion. Vanguard was second. I don't know who was third, but
where's BlackRock in that?
I don't know. That's what I'm saying. I don't know. That's
Didn't realize.
As soon as I said that, I thought, I wonder if BlackRock or iShares was third. There are 140 new ETF products launched in 2018, which is
just what we need.
Crazy.
It's exactly what Canada needs is more ETFs.
And there's a lot of growth in thematic ETFs, like HMMJ, the marijuana ETF from Horizons. It's got, do you know how much it has in it? Guess.
It's got to be well over $1 billion.
It's $1 billion.
Incredible.
It is incredible.
And for the first time, ETFs gathered more assets than mutual funds.
Yep.
This past year.
Yep.
So the tide is turning. And I remember the day when nobody knew what an ETF was.
Tide is turning, and I read some commentary on this, but it seems like, because this happened once before in 08, 09, and the commentary that I read was talking about how there's this paradoxical effect. When markets go down, ETFs actually tend to gather assets, because markets drop, people get nervous, sell out of mutual funds, and then when they get ready to go back in, they look for a lower fee option. So that's apparently what we saw. Well, that's what this commentator hypothesizes that we saw in 08, 09, and then also last year, obviously, where we did have some market volatility.
So we got a question this week from a listener talking about something that I actually saw in an article in Barron's as well, which is, does it ever make sense for a long-term investor to go to cash? And this is something, again, I saw in Barron's, which drives me crazy, this simple survey interviewing a bunch of financial advisors, investment advisors who were actually planning on adding to the cash position. So, Master, does it ever make sense for someone to go to cash?
Master. No, as long as we all understand that the context is we're talking about a long-term investor who does not need the cash at this time. Should they go to cash for market timing purposes? Should you time the market is what it boils down to. The answer is no if you're making a database decision. If you're really, really scared,
But boy, do people want you to say yes.
Well, of course. But there's no good argument. I mean, you look at the studies that Vanguard's done in the past, and AQR has done a study as well, to show the predictive power of any model. Like, you can find whatever metric you want. I think Vanguard found that the Shiller Cape was the best one. And even then, you only get 43%. You explain 43% of the difference in future returns using the Shiller Cape. So when prices are relatively high, there's a 43% chance you're going to get lower future returns.
But get this, 45% of advisors in this survey, now it wasn't a huge survey, but still they told the Investment News that they plan to increase cash allocations based on the performance of the past 6 months in the economy.
Sell low, buy high?
Yeah, prices went down on your equities. Therefore, if you believe in capitalism, you have a higher expected return. So that's the time to sell. Like, I don't get it, but I understand why people have the question.
Yeah, I get it too. I think we've looked at the past valuation data, and I think it was Raymond, our director of research at PWL, and he made a comment to me, it was a long time ago, must have been around when I started here. He said something along the lines of the only time that and not that he actually thought about going into cash, but the only time that he was really starting to feel like things were getting crazy was in the tech.
In 2000,
yeah.
99, 2000.
When valuations were like totally wacko relative to the past.
Yeah.
But I mean, even though Raymond, our director of research, even though he thought that this is crazy, we still didn't go to cash.
Yeah, it's easy in hindsight to say that.
Right. That's also true. We did get another listener question on home country bias and I guess multinational companies. So the question was the S&P 500 derives 43% of its revenue from foreign countries, that's pretty interesting in and of itself. But the question is, do I need to look any further for global diversification? So in other words, can I just invest in the S&P 500 because it has international exposure anyway?
Yeah, and you hear that argument a lot. And I mean, the fact of the matter is global markets are not perfectly correlated, especially when they get highly correlated when markets go down. I think that's when correlation goes up quite a bit, when markets are negative. But there's still a merit in owning multiple countries and multiple currencies in your portfolio. You just have to look at the performance of these countries over time and realize how different the returns are. And even inside each country, small cap and value can perform very differently as well. So you want to get this spray of outcomes inside your portfolio.
What did Larry say today? I think he said that there have been 3 13-year periods where U.S. stocks have underperformed treasuries.
13-year periods.
3 13-year periods. That's what, pretty sure.
Well, we live it here with Canada, right? People want...
Absolutely.
You go through 10 years of Canada outperforming and people wonder, why don't I have more Canada? Then we go through a decade like we just went through where Canada underperformed. Why do I have so much in Canada? And it always flips depending on the recent performance.
I think on this question, you have to think about the country-specific stuff. Like there are country-specific factors that are going to affect the price of all the stocks in a country, regardless of how much revenue those stocks are deriving from foreign countries.
Right.
Like just stuff like interest rates, something as simple as that. That's going to affect stock prices regardless of where they're deriving their revenue from.
And the fact is you cannot predict the future, so you want to own, we believe you want to own it all.
That's another piece of this actually, is that if you only own stocks in one country, even if they're deriving revenue from other countries, that's not truly a bet on capitalism. You have to be globally diversified to bet on capitalism. You can't bet on capitalism in a country because that bet might not work out.
Correct.
Totally different from betting on global capitalism. Yeah, anyway, it kind of ties into one of the things we want to talk about, which was the Standard & Poor's. They released their persistence scorecard. Did you see that?
Every year, never changes.
Well, they've been releasing the SPIVA report, the active passive comparison, for years. I don't know how long they've been doing the persistence scorecard. They've been doing that forever too?
That I'm not certain.
So they came out with an update for September recently, and they only do this for U.S. stocks, presumably because that's where they've got the most data. But what it does is it takes the best performing funds in the U.S. over a period of time, and then it takes those funds and looks at them over the following period of time. So it's kind of that test for luck versus skill.
Yep.
Where if a fund manager's skilled, they'll do well in a past period and then do well in a future period.
Right.
Whereas if they're lucky, they'll do well in the past period and then may or may not do well in a future period. So anyway, we kind of know what to expect because this report does come out. Well, it's been coming out, I think, every year as far back as I can remember, which is only, I guess, 6 years that I've been paying attention to it. So of the 550 domestic equity funds that were in the top quartile as of September 2016, only 7.09% managed to stay in the top quartile at the end of September 2018.
So 7% of the top 25% in September 2016 carried on.
Correct.
Wow.
And just by chance, we would expect 6.3% to carry on. So they did marginally better than you'd expect by dumb luck.
So still not enough data to know that it's skill.
Well, no, and the majority of them still underperformed or still got booted out of the top quartile.
Yeah, I mean, we can keep beating this to death. I don't get how people don't get this, but 43% of advisors that we just said are planning going to cash. So I don't know how people aren't aware of this data and how they think that they're going to be different.
Yeah, I don't either. I really don't. There's always a new thing or this time it's different type conversation.
I don't even get the motivation. Like, why do you want to? You have this evidence that you can implement with clients that has got decades of science behind it. Why would you not simply just embrace it with clients? Why do you want to do better?
Yeah, I don't know.
Like, what's the motivation to say, nah, basically forget about the history, forget about all the academic work. I think I'm going to do better.
Well, you can probably push it back on the clients, right? It's one thing for people who are giving advice to say we can beat the market, but it's a whole other thing if a client looks at what we do.
Yeah, if a client doesn't know, they don't know, that's one thing, but you're paid to know.
That's true.
You're paid to know the evidence. You're paid to deliver advice. How can your advice basically be against data like this? I mean, this data is pretty damning.
It's absolutely.
And you think you're going to be part of that, what that spread of 1% of that top quartile? Like,
it's completely damning.
I just don't understand someone's motivation to go that way.
Well, we've heard arguments in the past, all sorts of arguments.
I've heard them all. I just don't get it.
But I mean, you take an active manager who's picking stocks on their own and not using mutual funds. We've heard this. When Dan Solon came to Ottawa to have a debate with some local active firms, Dan talked a ton about the data. And the active firms they stated after the debate that they were disappointed that Dan referred to mutual funds because that data doesn't apply to them. It doesn't apply to the real good, small, boutique active managers that have...
Nimble.
Yeah, the nimble. Yeah.
Okay.
But that's that to answer your question, though. That's how they justify it. They have ways to justify it to themselves. It makes sense for them because of this, or it makes sense for their clients because of this. This is why we're different from the data. I'm telling you how they must justify it.
Yeah.
Because they're not sitting there looking it in the face and saying, we're going to do what's wrong. They think what they're doing is right.
So another common question, I don't know about you, but I've had it fairly often lately, which is, aren't we in kind of a winner-take-all type environment? And that I have to own Facebook, Google, Apple, Amazon, because they're going to own the world and they're the ones that are going to have all the growth going forward. And Came across an article that Jason Zweig, one of our favorite writers, had in the Wall Street Journal last week, looking back historically on this whole winner-take-all mentality. And basically his quote was, that's historical hogwash. So right now, Amazon, I think last week became the largest stock in the world at $800 billion. I know Apple was over $1 trillion briefly.
Both of them were briefly.
Last fall. And so they're right now about 3% of the market cap of all U.S. stocks. Number 2 is Microsoft, just a little bit less. And then Apple is third at $730 billion. But the question is this really historically abnormal? And did you know this? How many companies have actually been the largest stock in the U.S. since 1926?
Not until I saw this. Blew me away.
There's 11 companies, so we know them all. Amazon, Microsoft, Apple, Exxon, GE, Walmart, Altria Group, IBM, Dow DuPont, GM, and AT&T. But AT&T in 1932 was 13% of the total U.S. stock market. General Motors was 8% in 1928, and IBM was 7% in 1970. And I remember Nortel. Gosh, I should have looked that up. What was Nortel in the peak?
I don't know.
I think it was approaching 40% of the TSX. I believe.
Are you
serious?
serious?
It was crazy. That's why we had the Canadian Index X Nortel included.
Wow.
Yeah, or it was a capped index, XIC, capped index.
I didn't know that.
Yep. So I thought that was interesting, just that this is not historically abnormal at all. And if you think about these companies, will it be winner take all, or are these just reflective of?
Well, look at those data points,
times?
though. The data points that you have there are unbelievable. AT&T, 13% of the U.S. market. GM, 8%, I guess at its peak.
But yeah, creation of cars, or mass ownership of cars, development of phone systems.
These are all they're commodities that were at the time new. They're things that are now commodities, but at the time were new. And the first company to get into that space, of course, they're going to become
Microsoft,
dominant.
Personal computing, Exxon pioneered in the oil industry. So I just thought it was neat to look back and see, well, these are big changes, which is it different this time? I guess it might be, but just imagine how different it was back then when these companies came out.
Yeah. One of the other things that I think when I was reading your notes, a lot of these companies have had run-ins, at least, with antitrust law in the U.S. And I think that one of the things that gets missed in that winner-take-all idea that you have to own those biggest companies is that capitalism, in real life, capitalism is not just running free on its own. There are kind of three things that drive capitalism. There's market forces, the Adam Smith's invisible hand idea.
Yep.
But then there's also government regulation. And then there are also social forces, like how people are feeling. And to think that these companies are just going to take off and be, sail off into the sunset with everybody's data forever, is that realistic? Is the government never going to step in and do something?
Or will behaviors change? I just started reading a book yesterday called The Top 10 Reasons Why You Should Shut Down Your Social Media Accounts or something like that. Fascinating how many people are shutting down their accounts, and the author makes some pretty good arguments for it.
There's a part in the book Sapiens that I've almost finished reading now. It's taken me longer than I would have liked, but kids and stuff. But the author talks about how history is not deterministic. We can always look back on stuff and say, well, this happened because of that, this happened because of that. But in reality, history is just happens. It's random. And we can never, there's no way to know what's going to happen. So it's exactly what you're saying.
Did you catch 60 Minutes last night?
No.
They had this expert on AI talking about how it could eliminate 40% of the workforce. Like there's these huge, massive shifts that are coming. Who knows how it's going to end up?
Yeah. Who knows is right. I always love the Russ Roberts on Econ talked about the example of ATMs and about how when ATMs came, everyone thought that bankers were going to be out of the job. And what ended up happening was the cost of opening a bank branch dropped dramatically. So banks opened way more branches. And the net increase in bank tellers was positive.
Wow.
The tellers per branch decreased because of ATMs, but it allowed banks to open. Exactly.
Wow.
More branches, more people open accounts, attract more business, more tellers overall. So that's always stuck with me. Now, of course, AI is different from ATMs. Maybe, I don't know. But there's always these second order effects that we have to keep in mind. Anyway, on the winner take all thing, we always take it back to the risk story. And if we're really in a winner take all market, that's not a secret. The market knows, the market knows who has the data. The market knows who's the biggest company.
Who's got the cash?
Who's got the cash. So for it to really be truly winner take all, and for those companies to run off with all the gains, I guess, or all the earnings, well, not the earnings, all the gains, it means that they actually have to do better than the market currently expects them to.
Right. Because
everybody knows who's the biggest. Everybody knows who's the most successful, who has the most revenue, who has the most profit. But that doesn't mean they're going to perform well going forward. So are all the future gains going to come from those few stocks? I mean, no. They'd have to do better than the market currently expects them to for that to be true. And that you look at small companies who aren't as well, they're smaller. Their revenue is not as certain. Those are riskier investments. They've got more room to go up. The market doesn't think they're going to do well. So if they do a little bit better than expected, all of a sudden you've got better than market returns. And that's the whole risk premium idea of investing. Anyway, there was another article that dovetailed really nicely in when I saw that you posted the one that we just talked about. There was an article in The Economist talking about how the title was the most valuable resource is no longer oil, but data.
And that was one of the points of the interview last night.
Yeah. Interesting.
Because AI comes from data capture, right?
Yep.
Driverless cars, whatnot.
The article, yeah, they talked about in this article too, how I can't remember what it was. It was like driverless cars will generate 100 gigabytes of data per second or something crazy like that. But the article is talking about antitrust regulation. So that's kind of where, when I read the article that you posted, my brain went to, okay, well, regulation. And that's exactly what this Economist article talks about. So they said, quote, old ways of thinking about competition devised in the era of oil look outdated in what has come to be called the data economy. And then they had there's another good quote that I wanted to share. Google can see what people search for, Facebook what they share, Amazon what they buy. They own app stores and operating systems and rent out computing power to startups. They have a God's eye view of activities in their own markets and beyond. I thought that was fascinating because it's true.
Absolutely true.
They know if you have a great idea, they know about it maybe even before you do.
A great episode on Freakonomics we should put in the show notes that talked about the amount of information that Google knows about you and what you really do search. And they can tell things about society much better than surveys can because it's what you search for tells the truth of what you're really wondering.
That was a crazy Freakonomics episode. I remember that.
Yep.
Yeah, it's I can't remember what the term is, but if you answer a survey, the fact that you're answering the question affects your answer.
Correct.
Whereas if you're just Google searching, it's not impacted.
Yeah.
Anyway, so this Economist article boils down to saying that antitrust regulation will likely need to address this stuff, but it's going to have to take a different approach than it has taken in the past. And what that will mean, according to the article, is that instead of looking at company size when they're worrying about antitrust, they have to look at the extent of the company's data assets. So I thought that was pretty interesting. And then they also need to regulate the transparency and ownership of data. We were talking to a couple of pretty smart people recently about this, where their suggestion was maybe it makes sense for every company to release data with a 6-month lag or something like that.
Right.
So their competitors can't use it to get ahead of them, but at least everybody else can use it for research and product development and stuff like that. Anyway, we always have to remember that the world is a complex adaptive system. So it's not like stuff just happens and then people don't respond, because people are people. And so they'll do stuff as stuff happens. And we can never predict what the stuff they're going to do is going to be ahead of time.
So speaking of predicting, would you have predicted when we talked about CPP a few weeks ago that they would be advertising on NFL games in Canada?
No, I've seen a couple articles about this. It is kind of crazy.
Yeah. So, I mean, Andrew Coyne wrote an article, and a number of others as well that I've seen, just ripping into the CPPIB for spending, I mean, it's not a lot of money in the grand scheme of things, but $300,000 on ads, basically to convince people that CPP is a good thing. But as an employee, you can't opt out of it. This isn't an option. It's a monopoly. You have to do it. Employers have to do it. So he just took another opportunity to continue his, I guess, rant, you could say, on against CPP about how much they're spending. And here's a quote. So sheer profligacy is certainly one possibility. Spending at the CPPIB is quite literally out of control and has been for some time. Ever since the 2006 decision to switch from passive to active management, or from simply buying every stock in the market with an aim of doing no worse than the market averages, to picking stocks selectively in an attempt to beat the market, a task at which year in, year out, most investment managers fail. That's from Andrew Coyne in the Financial Post.
It's all absolutely true. I don't know why the CPPIB changed direction.
Back in 2000, he says it had a staff of 5. The CEO was paid $310,000 a year, total cost of $3.7 million. By 2006, I had 150 employees, and you kind of know where the numbers go. And today, CPPIB has over 1,500 employees. Average comp for these 5 executives, $4.5 million each, and total costs have grown to $3.2 billion, which is just shy of 1% expense ratio.
It's insane. Insane.
But they're advertising to tell you that it's a good thing.
Well, that the increase is a good thing. They're not talking about their active management. I don't even, why would they advertise the increase? I guess people might notice it on their paychecks, but that's not their job.
I read one article that talked about how many people think that CPP won't be there. I mean, we hear that once in a while.
Oh, yeah.
So they're making the point that it will be there, and it's a well-run, large plan.
It's true.
I guess.
It is.
But do you need to advertise that?
Yeah, I don't know. It is. I mean, sure, the costs are high and increasing, and obviously not a fan of the active management aspect, but it is a relatively well-run pension fund in terms of the funded status and the contribution rates and all that kind of stuff. And is it going to be there? I mean, yeah, that's not something that I worry too much about.
So do you want to go through some quick tax updates?
Yeah, so this is specific to owner-managers with a Canadian-controlled private corporation, or CCPC. So if you don't have one of those, which I'm sure many people don't.
You hit that little button to fast forward 30 seconds.
Yeah, you might want to skip ahead. Or maybe it's interesting anyway, I don't know. So the big, well, there's one change and one interesting point. So the change was that obviously I'm sure people who have a CCPC are aware that there's this new passive income limit where if you earn a certain amount of passive income, so it's basically like investment income from passive assets that you own, like stocks and bonds. If you earn more than $50,000 of that, you start to lose your small business deduction, which effectively means you can defer less tax. So you're paying more tax now and less later, but more now is the issue. And that was designed to do away with what a lot of people thought was unfair, the unfair ability of people with corporations to defer the vast majority of income tax. And all that was true, and that's debatable, whatever. We could get into a whole big discussion about that, and lots of people got pretty upset when all those regulations were being changed. But anyway, the news is that the Ontario government has decided not to follow the federal government's passive income limit. So I saw an article in the Globe Mail about this. I have not been able to substantiate it elsewhere, but I don't see why they would make it up. But anyway, it's pretty interesting. So provincial tax is a relatively small portion of the overall tax bill for anybody, but for a corporation as well. So it's not a huge deal, but it is still a deal, a deal to be aware of. I don't think it changes any planning. Like stuff like using the RSP became increasingly attractive when these rules changed because you can defer less income you'll run out of space to defer income sooner with the new passive income rules. So the RSP is increasingly attractive. That hasn't changed with this, but anyway, it's an interesting development. And the other one was that I learned, this isn't new, but I learned it to be true. I didn't know it before. Someone who has an active business in one CCPC and then also a holding company. So in a lot of cases, people will do that for creditor protection and things like that. And for the the capital gains exemption, got to have, anyway, that's getting too detailed. If you drop the active business and only have the holding company, then you are able to split income with a spouse pre-age 65 on the second generation income. So you've got investments in the holdco, you retire at 45 years old, you can still split investment income with a spouse as long as it's second generation income and you don't have an active business attached to your holding company.
Cool.
Anyway, I guess some technical tax stuff. Maybe some people are into that. I don't know.
So that's pretty much it for this week. We're busy doing TFSAs, RSP top-ups. Deadline's coming up in another 6 weeks or so. Kick off a new year. Anybody wants to meet, just drop us a note.
Tax time's coming.
Also, if anybody has ideas for guests, drop us a note as well. We can try to reach out and get people on.
It's true. We've been thinking about getting somebody on to talk about tax. So any good tax referrals for the podcast would be appreciated.
All right. Talk later.
That's it.